Hello, this is My Time Television covering United States stocks. Bye. Today, I'm going to tell you how to find dividend stocks. I'm sure many of you are interested in investing in dividend stocks. But when it comes to United States stocks, most people look at them from a growth stock perspective. And dividend stocks tend to attract those who want to receive steady income, like a pension. By putting more effort into dividend stock investing, you can enjoy both dividend income and capital gains. So I'd like to introduce these methods. Actually, this video is from a live broadcast I did recently for annual premium members. I made it public, and we also shared the top 5 dividend stocks by dividing them into 2 parts. Among those, I want to pick out only the areas you need when choosing dividend stocks, organize the educational parts, and share a few examples with you. So I'll divide this into 2 parts and explain it to you. Today, in the first part, I'll talk about several ways to choose dividend stocks. These are points you need to check, and among them, I'll talk about 3 things. Then, using one example, we'll look at when it's good to invest in dividend stocks. Yes, when you decide to invest in dividend stocks, let's say there are 2 companies, Company A and Company B, it would be good for you to think about which company you would invest in. Number 1 has a 10% dividend yield and its stock price rose 3% in a year. It seems things won't change much in the future. And let's imagine there's a company called B with a dividend yield of 1%, but its stock price increases by about 20%. So the total return is the sum of those 2. In 1 year, Company A would have about 13% and Company B would have about 21%. So if you guys, which company would you invest in? Especially, think about it as a dividend stock investor. A typical growth stock investor probably isn't very interested in dividends and would mainly focus here, but that's not the case for me. I keep looking for dividend stocks and building my portfolio with them. If there is a Company A and Company B's stock price growth may not remain at 20% and could be volatile. Some people might say that I prefer the more stable Company A, but with this concept, Company B might actually be better. Or maybe it would be nice to have a company that's somewhere in the middle between A and B. Some may think, combining the 2 could give a 4% or 5% dividend yield and a 10% stock price increase would be ideal. Because there are so many dividend stocks, I think you can generate and find them using specific criteria, but it's really about your own preference. Even if I choose this Company A, I can't ignore the stock price growth rate. So even when buying dividend stocks, in terms of total return, there are times when you should buy at a low, how to benefit from those opportunities, and also about dividends. Let's say they give a 10% dividend, but suddenly the dividend gets cut. Today, I'll explain how to filter out these situations in part 1 and then continue in part 2 next time. Today, we're going to learn about 3 things. First, you should remember that in dividend stock investing, a high dividend yield doesn't necessarily mean it's the best dividend stock. Usually, when you invest in dividend stocks or screen for dividend stocks, no matter which website you go to, if you click, they're all sorted in descending order based on dividend yield. If you can buy at 30%, it seems like you'll get rich fast. Why bother with the S&P or growth stocks? If a stock pays a 30% dividend every year, just buy dividend stocks instead. There's no reason for growth stocks. But those stocks yielding 30%, they're not always here. They only appear sometimes or just did this year as a special case, due to a special dividend, even with a 30% increase in the regular dividend. It was a dividend stock that sold assets to pay dividends, causing the stock price to drop 25%. After the ex-dividend date and taxes, almost no profit remained. In reality, you got a 30% dividend yield, but by the end of the year, the stock price had dropped by more than 20%. Additionally, after taxes and expenses, you might have little actual profit. That's why it's crucial to avoid those stocks when investing in dividend stocks. So if we look at some examples, Oxford Square Capital paid a dividend of $2.28 per share over 5 years. And if you look at 5 years ago, in 2021, when you first had the right to receive dividends, the stock price was $3.05. If I bought a share for $3.05, the 5-year dividend would be $2.28. Isn't that amazing? Or if you look on the right side, I've summarized the total return since I invested $3.05 and received $2.28 in dividends. The dividend yield is about 74.8%. That's incredible, isn't it? With this return, it's not bad. It's actually great. However, we shouldn't ignore that this must be considered alongside the stock price. If you check the stock price, I bought it at $3.05, but now it's dropped. It's $1.59. So if you calculate this, the stock price has dropped by about 48%. So if you combine these two, the total return is about 26.8% over 5 years. So if you calculate the annual average, it's about 5%. I invested in Oxupotio Sukio Capital because I heard the dividend yield was 10% or 20%. But if the stock price falls and you sell later, it might just be a dividend stock with around a 5% annual return. That's my point. Instead of investing for a 5% return, it's better to buy an S&P exchange-traded fund. And on Shein, it's important to look at dividend stocks from that perspective. So just because a stock has a high dividend yield doesn't mean it's the best dividend stock. I want to emphasize that it's very important to keep this in mind. Next, the second point is that it's very important to find companies that pay dividends every year, because companies that have stopped or drastically reduced dividends in the middle are very likely to do so again if there are any changes in the company in the future. That's why it's very important to find companies that pay dividends every year. So I've brought two examples to show you. One is ExxonMobil and the other is Boeing. ExxonMobil is a petrochemical company and Boeing is an airplane manufacturer. As you can see, the dividend per share has steadily increased. And if you look at Boeing, until 2020, its dividend growth rate was even higher than ExxonMobil's. They paid many dividends, but in 2020, it was reduced to a quarter, and then after that, there were no dividends at all. When we see a situation with no dividends, we call it a dividend cut. Actually, a reduction is also called a cut, but in this case, it's a complete cut. So now there are no dividends at all. So for companies that suddenly reduce their dividends or cut them significantly, you can say that their dividend stability is somewhat lacking. So we have certain indicators that we use to evaluate these dividend stocks. Let me talk about those together with you. So from the perspective of dividend stocks, companies like ExxonMobil that show this kind of pattern are much better companies. You can think of it that way. Then let me explain how you can check this on the website. Click on ExxonMobil to view it. Here on the right, a section called Dividend has appeared. So we've revamped and upgraded this dividend section. If you look here, you can see it says dividend score. I'm now explaining the structure and components of the dividend score. If you look here, for example, ExxonMobil has a perfect score of 100 out of 100 for dividend increases, 100 for consecutive dividends, 100 for payout ratio, and even the earnings per share growth rate is quite high at 63. ExxonMobil also has a decent dividend yield. So this is the kind of company we're talking about. You can see that this company has increased its dividends for 42 consecutive years. But earlier, as I mentioned about Boeing, if you look here, it says that they are currently not paying any dividends at all. If you scroll down to the bottom, the dividend yield was 2.8%, but it's now gone. And the dividend per share is 0. That's the situation. Previously, the payout ratio was 40% to 50%, meaning about half their profits went to dividends. So they should still be paying out roughly the same amount now. Then we need to look at whether this company is not making any profit right now. So regarding that part, now here, if you go into the overview, you'll see the performance results. So I think you should check that part. When I scroll down, I saw earnings per share stayed in the red through 2024 and into 2025, right? So it seems like they couldn't provide dividends, and for next year, 2026 and 2027, it's expected that they'll turn a profit. So at that time, there's a possibility that they might resume paying dividends. Previously, the dividend payout ratio was about 50%. So in this case, if it's $6, they might be able to pay dividends in the low $2 range. Then at around $215, the dividend yield would be about 1%. Anyway, it's turning around. However, in the case of good dividend stocks, even if their earnings temporarily decrease like this, they don't completely cut or eliminate dividends like that. So there are quite a few cases where they try to maintain the dividend by raising the payout ratio. Shall we take a look at ExxonMobil? ExxonMobil, if you look at ExxonMobil. In this case, if you look at 2020, you can see there are years when revenue and earnings per share decreased, right? Even though there were years of decline, the dividends kept increasing. If you look at ExxonMobil, you can see below that they have steadily increased their dividends. These companies have high dividend stability, and as shown below, their payout ratio usually ranges from 40 to 60%. What that means is, even if the earnings per share decreases a bit, the payout ratio is about how much of the earnings are paid out to shareholders as dividends. So there's still room to increase this. If you look at 2019, you can see it was over 100%. That means they paid out all of the earnings per share as dividends without keeping anything in the company, and at the same time, they increased the dividend. In 2022, the dividend payout ratio is negative, but that doesn't mean they didn't pay dividends. It means they paid dividends even though they had a loss. Although earnings per share was negative, they still paid $3.48 per share dividend in 2020, causing the negative result. So that's how stable their dividends are. If you look at the overall score, if it's over 80 points, it means the company has very good dividend stability and is also growing, increasing its dividends. That's how you should see it. So for you all, it's not just about what percentage or how many dollars the dividend is right now. It's more useful to look at whether there were any cuts in the past and to check this kind of data. The third is, some companies pay annual dividends without increasing them, while others raise them each year. Companies raising their dividends become more attractive dividend stocks. So companies that don't cut their dividends are good, but it's even better if they not only maintain but also increase their dividends even just a little every year. And if the dividend grows faster, that's even better. Finding those kinds of companies is the third key point. So those companies, among the data we have, a company called Genuine Parts was ranked first among companies with a dividend score of over 80. This company has continuously increased its dividends for about 68 years. This suggests they will likely keep raising dividends, even looking only at the past 10 years. In 2016, it was $2.60, but now it's about $4.10, so it's rising even more. That's an increase of about $1.50, which means that just the dividends over the past 10 years have grown by about 60%. So if you look at this company, in 2016, the stock price was about $84, and the total dividends over 10 years add up to $33.18. That's the sum of all the dividends. So if you calculate this, the dividend yield was about 39% and the stock price was $84, but recently it's $138. If you divide that, the stock price went up by 63% during this period. So if you combine these two, the total return is 100%. That means over 10 years, your return would be double. So if you average this out annually, it's about 7.3%, around 7.3%. Since the S&P's growth rate is usually close to 9%, it's lower than an exchange-traded fund of the S&P index. So it's not like high dividend stocks bring in a huge amount, but the advantage is that for people who need to receive some income every month from these dividends, dividend stocks are necessary. If you only care about stock price growth, it's best to sell when the growth rate peaks. For people who need to live off something like a pension or monthly dividends, these dividend stocks are very important. And even if they don't completely outperform the index growth rate, for those who need something through this form of dividends, these can be really good dividend stocks. So companies that steadily grow their dividends are really good, and the actual yield will probably be even higher than this. I haven't factored in the reinvestment of my dividends here. You know this $33, right? This is assuming that you spent all $33 as cash. If every time you received this $33, you kept buying more dividend stocks with the $5, $2, $7 and kept reinvesting like this, then your actual rate of return would be a bit higher than this. It would be higher. Reinvesting dividends increases your rate of return. The stated rate assumes you spent all dividends. I think this is a helpful way to understand it. So last time I did this for the annual premium members of the Dividend Stock Group. Together with the Mijun TV members, we held 2 Dividend live sessions. The first time we revealed the top 5 stocks from a traditional dividend stock perspective, and then the second time, we identified 5 stocks that recently began paying dividends or have low yields but strong potential for significant future dividend growth as dividend growth stocks. So in part 2, I revealed the top 3 out of those 5 and talked about those stocks. Now in part 1, I considered all 5 stocks to be pretty solid dividend stocks. From a dividend perspective, for those who need to earn some income while living, the 5 stocks covered in part 1 are more useful. Among them, Merck was the 3rd company I covered. So as I talked about this company while covering it as one of the 3 stocks, in the previous video when we talked about healthcare and pharmaceutical stocks, I mentioned that Merck had gone up a lot. So the thing is, at that time, this stock was really at the bottom, making it very attractive as a dividend stock. So when we looked at things like dividend stability, yield, growth, and projected earnings, we thought there was enough potential for the company to continue paying solid dividends in the future. Just refer to the previous chart from earlier. That's what I mainly used to explain. So what this chart shows is that Merck's current dividend yield is about 4.0%. And over the past 5 years, the highest was 4.1%. What that means is the point when this company's stock price was at its lowest, within the last 5 years, that's when the dividend yield hit 4.1%. The average is 3%. But currently, this company's stock price, as of September 16th, it's $81.09. And this part of the yield, the point where it becomes 41%, it's $79. Like I said, we're almost at that point now. In the case of a company like Merck, even from a dividend stock perspective, the chart doesn't look good and the shape isn't good. But even if you actively buy it, the expected return as a dividend stock itself is the valuation. I thought it would be possible to do it stably. The amount written in green in the middle is... Now, using the standard deviation, we calculated the point with about a 90% probability. So what dollar amount is that? It's about $90. So the section below $90, the section between $90 and $80 is down here. Overall, the probability of this happening is only about 10%, so it's a rather unusual case. If you happen to be in that period where there's a 10% chance, buying dividend stocks would mean there's a much higher chance they'll go up. So I mentioned that between about $80 to $90, Merck becomes a very solid and outstanding company as a dividend stock. If you actually look at the stock price, recently Merck has if you look at the low point, it was formed at around $77. So on September 16th, from our perspective as a dividend stock, at around this price, it's okay to buy a bit. That's what I meant earlier. Yes, $80, yes, around $70 per share. And then if it's a lot, around $90, honestly, that's not an amount you see often. So as a dividend stock, that's quite an attractive amount. As I mentioned, even from a general stock perspective, not just for dividend stocks, if you look at how buying and selling happens like this, it's a good thing. But recently, as the stock price surged and a buy signal appeared here, even just looking at the dividend yield, we can say these points are in the low range. If you look at the exponential moving average chart below, you can see the trend. From a trend perspective, it kept going down, and even at this time, it was still falling, so it's true that it wasn't good. So the trading signals I mentioned also check supply and demand. Even though it was a cheap, good company, after buying, the trend broke down, so it was sold to cut losses. Now, as supply and demand recover, the artificial intelligence found a new buy signal. But if you only consider the dividend yield earlier, for his 30,000 flows crude, it's attached. Beidal Minjok earlier This range around $78 to $80 is an area where the stock price is trading at a very unusual level. So these parts are about 41% that I mentioned earlier are in this range, the range where it breaks below $80. At times like this, buying for the long term can be considered quite good. Then how high can this company go before its earnings per share completely changes as a growth stock? Yes, I'll calculate and explain those parts in part 2 next time, but there's a reason I wrote this here. This part here, the 3 and 0, refers to the average return over the past 5 years. The price at which the average dividend yield becomes 3% is $108. So on average, the stock price usually moves in a pattern where it drops from above the average to below, hits the lowest point, and then goes back up to the highest point. At the very least, there's a very high chance it will break through $100. That's how I see it. And if it does break through $100, there's a possibility it will steadily climb up to the point of the highest dividend or the lowest dividend yield. But since it's not an explosive growth stock, you can buy and sell dividend stocks within that price range. Or if you sell and then buy again, you can buy more shares for the same amount of money. If you end up buying more shares, the dividend per share and the total dividend amount will also increase, so you can approach it that way. If you keep increasing your dividend stocks themselves, there is a way to increase your returns through dividend stock investing like this. So rather than holding them permanently, if you increase the number of shares like that, it's a way to increase your dividends themselves. I think this method will help you discover dividend stocks more easily. On the last site where we look at this list of dividend stocks, we've added a bit more to that recipe for you. If you look at the menu, go to Discovery, then click on Investment Recipes, and then go into Hot Stocks of Interest. You'll see the fourth option here called Attractive Dividend Stocks. If you click on this, we first organize them for you in order of market price and dividend yield. So earlier, I used Oxford Square Capital as an example because it's at the very top. This one does have a 30% yield though. If the stock price keeps falling due to poor earnings per share and earnings, and the annual decline nears 30%, the stock becomes worthless. That's my point. Compared to that, since you're getting dividends, you also have to pay dividend taxes. So you need to take those things into account. That's why it's really important not to just look at stocks ranked by dividend yield in descending order and think they're attractive stocks. Click here to view by industry or market capitalization and check consecutive dividend increases, payments, or dividend scores. You can set these options. So if you click on consecutive dividend increases, you'll see the company I mentioned earlier as the first example, Genuine Parts. So from this perspective, the ones with higher dividend yields are actually the better ones. Yes, and then the dividend score. The dividend score is shown out of a total of 100 points. If you look here, you see 9%, 6%, and there aren't really many with a 20% yield, right? So it's really good to choose from these kinds of stocks. These could be better dividend stocks. If you sort like this, I think it will really help you discover good dividend stocks. Next, I'll explain what you need to find the rest of the dividend stocks. I'll explain a few more useful strategies or methods, and also introduce some good dividend stocks that fit those criteria. I hope this video will be very helpful for you in finding dividend stocks.